Welcome to the land of Oz. It's not necessarily it doesn't necessarily have a wizard, but it does have tax benefits, which people are very interested in right now. And so people want to know, what's an opportunity zone? Well, if you bother to, not if you bother to read, but if you ever need, a good night's sleep, read the 2017 Tax Act and then read section 1400Z. My friend Plankton always tells me about Evil Plan Z. It's evil, it's diabolical, and it's limit-scented. And in some respects, opportunity zones were put at the back of the tax bill, and there wasn't much focus on them when the bill was passed. But opportunity zones are effectively low-income areas that are designated by the governors of the 50 states, the District of Columbia, U.S. possessions, so the island of Puerto Rico has opportunity zones. And effectively, they are areas identified by census tracts, not by zip codes, not by geographical boundaries, but by census tracts, where 20% of the median family income is less than 80% of the statewide average. So they truly are identified as low-income communities. Every governor nominated areas in their state. Governor Brown sent his nominations in the end of April last year. In August, the Treasury Department identified what areas were going to be opportunity zones. There's 8,700, slightly over 10% of them are in California, so California has more opportunity zones than any other state. We'll look at a map. Some of the areas that are, listed here: East Village, National City, Southeast San Diego, El Cajon, downtown Escondido, parts of Vista, Paris, Winchester, San Jacinto, Hemet, San Bernardino, and then if you go north, basically every county in California has opportunity zones, and we have a number here in not only the city of San Diego, but in San Diego County. And so if we look at a map, this is the green areas you see on the map are opportunity zones throughout the state. This is downtown San Diego with a marked opportunity zone. This is Market Street that's running here. This is Petco Park, so you can see basically the beginning of the opportunity zone. It runs all the way down through Logan Avenue, then into Lincoln Heights, kind of across where the Jacobs Center is located, and so that opportunity zone runs through Southeast San Diego. If you're interested, if you Google just California opportunity zones, the California Department of Finance has an interactive map. So when clients call me and say, hey, I'm under contract to buy a property, I type in the address in the interactive map. It tells me whether it's inside or outside an opportunity zone. Sometimes they know that. Sometimes they're surprised that they're in an opportunity zone. If they are, then the discussion is, well, do you want to do an opportunity zone fund? And I don't know why we lost, for some reason we lost part of the top part of the slide, but kind of the way that opportunity zone funds work are that if I sell an asset here in 2019, whether it's stock or real estate, I will have capital gain, either long-term or short-term capital gain. I'll have 180 days from the day that I sell that asset to decide whether or not I want to go into an opportunity zone. If the asset's owned by a partnership or LLC, the partnership or LLC will have 180 days to decide. And if it decides it doesn't want to invest in an opportunity zone, then I, as a partner or member, will then have 180 days after the end of its taxable year to decide whether or not I want to reinvest my gain in an opportunity zone fund, a qualified opportunity zone fund, a QOF. If I do that, then these are the tax benefits I get. The capital gain that I recognized this year in 2019 gets deferred. I don't have to pay the tax till December 31, 2026. If I'm invested in the opportunity zone for 7 years, which means I got in 2019, and I was there in 2026 at the end, then 15% of my capital gain is forgiven. If I'm only in the opportunity zone for 5 years, so either I just deliberately don't stay in for the full 7, or let's say I don't invest by the end of this year, but I invest by the end of December 31, 2021, then 10% of my gain is forgiven. So that's what happens on the relinquished property, and the property that I sold this year and I had a gain on. If I invest in the opportunity zone for 10 years or more, the property I invest in, when I go to sell my interest in that opportunity zone fund, that gain is in effect forgiven. I get to step up the gain to the fair market value of the interest. So we're dealing with both gain on the relinquished property and we're dealing with gain on the replacement property. Relinquished property gain, what I sold this year, gain is deferred to 2026. A portion of it is potentially forgiven. And gain on the property I bought in the opportunity zone, if I'm invested there for 10 years, I don't pay tax on that gain when I sell it if I've held it for more than 10 years. So there's kind of a couple of different benefits, and it's easy, quite honestly, it's easy for people to get confused. So what do I have to invest? I have to invest my gain. So it's not like Section 1031. 1031 tells me if I sell an asset and I want to defer paying tax on it, I've got to take whatever I receive, my amount realized, my sales price, and I got to pour it into the replacement property. Opportunity zones, what I'm required to do is whatever I had in gain when I sold the asset, I've got to invest that in the opportunity zone fund. So my basis or my cost, I don't need to invest. I get to put that money in my pocket. There's no direct tracing. So if I sell an asset for $1 million, I got 180 days to reinvest. I can go to Las Vegas, I can blow the $1 million. I got 180 days to come up with $1 million to invest in an opportunity zone fund. So it's different than Section 1031 where the money needs to be held by the qualified intermediary. And generally to be an opportunity zone fund, effectively 90% of my assets need to be in the opportunity zone. And that can either be property that I own in the opportunity zone, or it can be a partnership or LLC that is invested in the opportunity zone. And why might I pick a partnership or LLC? Well, because if I'm a fund and I invest in a partnership or LLC, then only 70% of that partnership or LLC's assets need to be in the opportunity zone. So I get a better rule for most clients if I create a fund and the fund owns another partnership or LLC, and that's invested in the opportunity zone fund, because then I can have more assets that may be outside the opportunity zone. I'm just investing in real estate. It's not really that much of a concern. If people are interested, I can talk to you about it. I have my first client where I'm not going to do a partnership or LLC. I'm going to invest directly through the fund, and we have reasons for that. But normally, the typical opportunity zone fund structure is a partnership or LLC that takes the money from the investors, a partnership or LLC that owns the property, that actually acquires the property, and we'll see under the current rules that property needs to be substantially improved. So we'll talk about what substantial improvement means. And these are the subsidiaries. People get interested in this. When you look at it, when Congress looked at creating opportunity zones, they looked back, they didn't look forward. So they talked about census tracts. When was the last census? Well, it was in 2010. So if I'm going to identify low-income communities, and I'm going to use census tract data, I'm going to use 2010 census tract data. So I'm going to be looking back. I'm not going to see gentrification in places like Brooklyn and East Village or West Hollywood. I'm going to say those are low-income communities because in 2010 they were, but maybe they're not anymore. The other thing is that Congress decided that you shouldn't be able to invest in sin businesses, and they took a 20-year-old definition of sin. So the definition of sin businesses are basically golf courses, country clubs, massage parlors, hot tubs, suntan facilities, racetracks, off-track betting, off-track gaming, and basically for a principal business for the sale of alcohol for off-premises liquor stores. Those were the sin businesses. So these are the things you can't operate in an opportunity zone subsidiary. Well, people say, well, I mean, one of my first opportunity zone clients came in and said, well, we got a great project. It's in Cathedral City, but the tenant's going to be a cannabis distributor. I said, not a problem. It's a class 1 felony, but it's not a sin. And being a practicing Catholic, I understand the difference between venal and moral sins. And so, the sin definition is a 20-year-old definition that's looking back. The other thing that Congress didn't deal with here is this says that I can't do it, but it doesn't say my tenants can't do it. So the fact that my tenant's a liquor store doesn't impact me because it's not my business. It's the tenant's business. So in many respects, these sin business restrictions are fairly easy to maneuver and get around. So these are the businesses that may be a problem, and like I said, we typically can find ways to deal with it. And you're either buying the property directly in the fund or you're investing through a subsidiary. And like I said, most of the time, we're actually going to invest through a subsidiary. All right, one of the big requirements is to have opportunity zone property. It's got to be acquired by purchase after December 31, 2017. So if I owned the property before December 31, 2017, it's not good property. It needs to be sold over to a fund. So what does that mean? Well, I can sell it over to the fund, but the fund and the seller of the property can't be related parties, which means that the seller can't own more than 20% of the capital or profits of the fund. So if I own the property in 2017 or before, and I want to sell it over to the fund to be able to offer these benefits or get these benefits, I got to create an entity that becomes a fund. That's not hard. I got to sell it because I can't contribute it, and I have to understand if I'm going to take my gain and contribute it to the fund, whatever I get, I can't have more than 20% of capital or profits. If I do, then it's not a good sale transaction. Now that doesn't mean I can't sell the property over to the fund and invest in 5 different funds. No restriction on the number of funds I invest in as an investor, so I can seed a bunch of different properties. But I do have to worry. I got to basically buy from an unrelated party, and the related party definition is really, from a tax perspective, is relatively low. If the seller of the property owns more than 20% of the buyer, it becomes a related party. And so those are kind of the big definitions that typically I'm worried about. Like I said, forming a subsidiary, that's relatively easy. This is kind of a rehash of what we've talked about. And then this is really kind of what I need to wind up doing. If I do a traditional structure and I form a sub, what I need to do is I need to substantially improve the property that's acquired in the opportunity zone. Well, what does substantial improvement mean? That means when I acquire the property, I allocate my purchase price between land and improvements. So land and building. Whatever I allocated to the improvements to the building, I got to spend on that property in the next 30 months after I acquire it. So from a time period standpoint, I create my fund. From the day I get my first investor dollars, I've got 6 months to buy a property in the opportunity zone. After I've done that, I've got 30 months to substantially improve it. So I'm really looking at a 36-month maximum window to go from investor dollars to buying property within 6 months to improving property within 30 months. That's what I need to do. And I need to spend, if I buy the property for $5 million and I allocate $1 million to the improvement, I got to spend $1 million rehabbing that property over the next 30 months. So not every property is going to qualify. What's an ideal property going to look like? It's going to look like a piece of property with a lot of potential and a crappy building on it. Why? Because it's got a lot of potential and it's in an opportunity zone, and whatever I allocate to that crappy building, that's what I know I have to spend over the next 30 months. So if the crappy building's worth $250,000, I know I got to spend $250,000 either fixing, rehabbing, doing something else with that building over the next 30 months. Yeah?
Do you have to declare the allocated cost for improvement?
You do. You do. So it's a good idea to get an appraisal to be able to substantiate it. But yes, you're going to have to certify with your first tax return as a fund that you meet the fund requirements, which means whatever I allocated to the improvements, I'm going to spend that within the next 30 months.
That number's not fluid, it's stuck.
Well, yeah, I mean, it is stuck. I mean, whatever I allocated, you know, I'm really setting the bar. So wherever I set the bar, I better get over it. But, you know, I do have flexibility. The nice thing about it is I self-certify. So I say I'm a fund, and I meet all the requirements, and that's what I have to do every year. So it's, you know, in some respects, I have a lot of control over the process. But, you know, you know, really this is how, you know, quite honestly, this is how it works. And so because I have 30 months to renovate, substantially improve the property, when I look at my assets, I have to say, well, you know, either 90% of the fund's assets need to be in the opportunity zone, or if it's a sub, 70% of its assets need to be in the opportunity zone. Well, the real estate we know is in the opportunity zone. But what about the money that I've got sitting there waiting to do the rehab? And really what the IRS has said in the first set of proposed regulations is, well, if you have a working capital plan and you have a plan to spend that money on the property over the next 31 months, we'll give you one extra month to get things paid for, then the working capital is also invested in the opportunity zone. So if I buy the property, okay, I've got one amount that's invested in the opportunity zone, but I know I have to substantially improve it. What about the money I've got to be able to do that? As long as I have a working capital plan saying, okay, this is what I'm going to do. I got $1 million. I'm going to spend it on the property. This is how I'm going to spend it, and this is when I'm going to spend it, and it's all going to be spent in the next 31 months. Then that working capital becomes an opportunity zone fund asset as well. Yeah.
What about for acquisition of land?
Well, you know, if I just do a ground-up development deal, where let's say it's just raw land, we don't have rules that tell us how that's an opportunity zone asset. The IRS, in the first set of regulations, said, okay, we're going to give you rules on substantial improvement. And in our second set of regulations, we're going to talk about ground-up development, and they haven't issued those rules yet. So I can't tell you what you need to do on a ground-up development project. Pure raw land. I mean, I've got clients that want to do deals. I was talking to somebody today, and he's like, well, you know, it's kind of this piece of dirt with some fencing. I'm like, well, you better find something else there. You know, you better find some improvements, because if we're going to buy it and substantially improve it, we need to have something there. So that's what he's going to do tomorrow. He's going to figure out what else is there on the property. But we only have rules for substantial improvement, which is rehab, renovation. We will have rules. We were supposed to have rules by the end of last month on ground-up development, and we don't have rules. Now, the good news is we know the rules are done. The IRS announced this morning they're going to start on the third set of regulations, which means they must have finished the second set. But the second set has to go to OMB, has to be reviewed. It'll be at least 10 days before it's published. But presumably they're done with the second set of regulations. So like I said, we don't really know how ground-up development is going to work. You know, the sin business restrictions is if I'm inside a subsidiary, and they're kind of different tests, whether or not you have an active income, whether or not you want to do it inside the fund or inside a subsidiary. Original use, that's ground-up development. We don't know what original use is. What the IRS has said is, well, with real estate, the original use is, well, whenever the first person walked across it. So whenever an indigenous person walked across it, that was its original use. So you'll never have original use. So we'll have to give you a definition of what original use means. And that's really what we're waiting for. And what most people believe is, you know, the IRS, if you look at opportunity zones, in some respects they're supposed to replace the new market jobs tax credit provisions. And the new market jobs tax credit provisions had a rule that said, if I had a vacant building and it was vacant for 12 consecutive months, the original use started all over again. So if I had an empty Kmart site, or I had an empty Sears building, and it was vacant for 12 months, the original use started all over again. People are trying to get the IRS to accept that as original use. And so that's why the guidance has been delayed, because people want to have this notion of evergreen, that original use can start over again if a period of time has passed. And maybe the IRS buys into it and maybe they don't. But like I said, we don't really know what original use necessarily means. Like I said, if you're dealing with the purchase of property, the IRS has this revenue ruling that basically says whatever you allocate to the improvements, that's what you have to spend. That's what substantial improvement means. So if it's $250,000, you got to spend $250,000 over the next 30 months after you buy it. If it's $1 million, you got to spend $1 million. And you got to spend it. Not that you have to be done with it. Not that it has to be completed. It's a pure expenditure test. You got to spend this amount of money over the first 30 months that you own it. And like I said, raw land is a bit of an issue, a bit of a problem. Debt, can debt be used? Absolutely. So I can backfill. So I buy the property, I need to spend $1 million on improving it. Uh-oh, the investor money shut off. I only have $500,000 of investor money and I know I need to spend $1 million. I can go borrow the other $500,000. I can always backfill with debt. So either the purchase of the property or the substantial improvement can be dealt with debt. IRS says that's fine. IRS also says if I want to raise money from people other than folks that sold assets, new money investors, somebody just comes along and says, hey, that looks like a great project, I want to put money in there, but I didn't sell real estate or I didn't sell stock. I can take that. It's called a mixed fund. And all I'm required to do is I'm required to treat the folks that are invested in the opportunity zone and getting the benefit of that investment. I'm required to treat them as one group of investors and the new money as another group and separately allocate everything. But I can, like I said, I can backfill with either debt, I can backfill with other forms of capital contributions in order to be able to meet these requirements. You know, forming the fund, it really is simple. You know, in some respects, it's a partnership or it's an LLC. That's the fund. We typically want to have a brand new entity. We don't want to have any history. Not that we're precluded from it, but really what winds up happening is from the moment I take investor dollars, the first dollar of deferred gain, I've got 6 months and then I have my first testing period. And on my first testing period, 90% of my assets need to be in the opportunity zone. So whether it's either property I buy or if I form a subsidiary and the subsidiary buys it, I've got 6 months to make my first testing date. So I'll have a testing date. Let's say I form my fund on March 1st. I'll have my first testing date on September 1st. And then I'll have my second testing date on December 31, the end of my tax year, if I'm a calendar year taxpayer. So you realize that you have to file and say, I meet these testing requirements. I'll have 2 testing dates each year. And it becomes important. And a client that called on December 20th saying, I want to form a fund. I said, that's great. He said, I have any problems? I said, sure. If you're a calendar year taxpayer, you've got 11 days to buy property because your first testing date's going to be on December 31. So if we're going to do this, we need to form a fund and we need to elect a fiscal year end, November 30th. So your first testing date will be May 31st instead of December 31. So these testing dates, in some respects, are kind of important. We have to meet these requirements on these particular testing dates. And like I said, it's all certification. The 90% test, like I said, for real estate, the 90% test is really pretty easy. When I'm talking with business lawyers and I know I have to have 90% of my assets in the opportunity zone, sure, if everything's down, in the office and in the opportunity zone, that's easy. But if I have cars, if I have trucks, if I have cranes, if I have something else outside the opportunity zone, it's more difficult. People say, well, how do I determine 90% of my assets? And the first set of regulations say, well, if you file with the SEC or any other government entity, which most companies don't, then you use those values. If I don't do that, then if I have certified financial statements, I use my GAAP values. Well, most people don't have those. Then finally, the IRS said, we just go to your tax return. What's your cost basis in the land? What's your cost basis in the improvements? What's your cost basis in the substantial improvements? So, in many respects, clients kind of say, well, gee, I'm going to buy this property. Maybe I need to get it entitled. Maybe I need to get a building permit. Well, in some respects, that's good and bad. That building permit, those costs to be able to build that building, that counts for purposes of substantial improvement. You are spending that on the building. Kind of the difficulty is, if you're going to spend, 24 months getting entitlements, and you've got to actually substantially improve the building, you have to understand you've got a 30-month window from the day you acquire it to the day you have to spend whatever that necessary amount of money is. And the more you're in the entitlement process, the less you're in the construction process. So in many respects, getting back to the idea of what's the ideal opportunity zone property, it's stuff that's already entitled. It's something that you can build on, that literally you can acquire and start building on the next day. Yeah, question?
Do you need to complete the improvements? Or
No, spend the money. It's an expenditure test. It's not a completion test. I don't need to have a COP as of a particular date. So that's one nice thing about it. Because like I said, in some respects, people say, well, describe to me the ideal property. That's fine. Well, describe to me the ideal opportunity zone sponsor. In some respects, I said, well, it's an opportunity zone sponsor that either owns a general contractor or has a relationship with a general contractor. Because then you can control the expenditure of money. Because you've got to spend the money out over 30 months. And so not that the work needs to be completed, but you need to be writing checks, which means I can't have a work stoppage. I can't have a strike. I can't have people basically picketing my project where I'm not spending any money on it. I need to be able to work through this construction project within 30 months.
No advance payment to the DC?
Well, remains to be seen. Well, I mean, what the IRS has said, this is an expenditure test, so technically, as long as I spend it, it's good. In the 1031 world, the IRS has said, well, if you blow your exchange money out and the work isn't done yet, we'll treat that as boot because it's services that you paid for, and you didn't pay for real estate. So it remains to be seen. We would expect them to have kind of the same rule here as they have in 1031. So this is the 90% test. I mean, most of the rest of these slides really deal with, how you set these funds up. And it's really, it's not like what we typically think about as funds. If I want to create a fund, I create a fund. Now, what I will need to do for tax purposes is these things really work for partnerships. So I need to have a second owner. But it can be a spouse, it can be an employee, it can be an entity that I own. Worst comes to worst, I form an S corporation and that becomes the second owner. And many of the deals we're doing right now are one-off deals where it's basically one party. I'm buying the property and I'm fixing it up. And I'm treating it as an opportunity zone. There's no restriction on that. I don't need to have 100 investors. I don't need to have 20 investors. I need to have 2. And I can create the second one if that's what I want to do. So it's in some respects, the setup's extremely simple. It's a very, very direct approach to try to get money to go into these low-income communities, to get people, to encourage people to invest in these low-income communities and to improve the property that's there. Basically, with respect to the property that I sold this year and reinvested, kind of the music stops on December 31, 2026. People are already asking Congress to extend that date because they don't like it. They think it's too close. And it remains to be seen whether or not Congress will do that. And then, like I said, if I have working capital, if I have money that's either in the fund or in the subsidiary, and typically it's in the subsidiary, as long as I have a working capital plan and I expend the money effectively substantially consistent with a working capital plan, then the money becomes a good opportunity zone asset for purposes of the testing, the 90% test. And like I said, mixed funds, you know, I can have both deferred gain and other sources, new money, other sources of capital, and I can put them all together in the fund. So all of that can be combined. Like I said, you know, I can, you know, it's about 10 minutes to 6. I can go on for the next 3 hours about opportunity zone funds. They've got a lot of, you know, it's like anything in life. You know, you can pick it up and you can see kind of just in general what it looks like, and then there's a lot of subtleties to it. But it is, you know, it is there. You're seeing premiums paid. Rami and I were talking about a property that they sold in the opportunity zone. You're seeing some premiums being asked for. You're seeing premiums paid. You know, what side of Market are you on? What side of El Cajon Boulevard are you on? If you're in the Opportunity Zone Fund, you're seeing that property selling at a higher price than the property on the other side of the street that's not in an Opportunity Zone. The IRS has said, if we told you it was an Opportunity Zone, you can rely on that. Now we may, when the new census is out in 2020, we may move these Opportunity Zones. We may designate new ones. But if you go in based on the information we gave you today, you're entitled to rely on that. So like I said, they are everywhere. They are up and down the state. They're across the country. You know, you don't have to go here in California if you don't like California. There's South Carolina, Georgia, Louisiana. We've done Opportunity Zone Fund deals in other places. But in many respects, most of them we've done or have been in San Diego or Southern California.
So are those zones grandfathered in, or are they?
Yeah, they're grandfathered in. Yeah, Treasury said, if we told you it's an Opportunity Zone, it's an Opportunity Zone. We may be wrong, but you get to rely on whatever we told you. Yeah.
What is the franchise tax board in the state against that?
The state says nothing about this, which means there's no state conformity. If I sell the asset, I pay California tax on it in 2019. If I invest in the Opportunity Zone and I sell that in 10 years, I pay tax on that in 10 years. California is probably not likely to adopt this provision, so it's federal only, and about 30 of the 50 states have it. Other questions? Yeah.
So this has been around for about 2 years, you said?
Well, I mean, realistically, it was in the Tax Act in December, the end of December, December 22nd, 2017. Nobody could really do much with these things without regulations, and the regulations didn't come out till October. So realistically, you know, I had a few private office clients that did Opportunity Zone deals last summer, but all we could really say is, you know, maybe these work and maybe they don't, because we don't know what it takes, and they were pretty speculative. After October, now you're beginning to see people do it because we know what it takes to form these funds and what it takes to substantially improve property.
Yeah, and kind of following up on that question, how many of these opportunity zones have you guys seen, like, over this period of time, trying to transition to rent-controlled areas? The correlation between rent-control and opportunity zones.
Well, you know, in some respects, you know, we've dealt with the only place I've really dealt with it is Berkeley and Oakland. And in both instances, the clients were kind of aware of what they could do on a rent control side. You know, I don't think Santa Monica has one. I mean, I'm trying to think of the rent control communities. I don't think Santa Monica has an opportunity zone. So I don't think, like I said, Berkeley and Oakland are the only ones I've dealt with. And you know, we kind of warn the clients about it. And you know, quite honestly, the guy in Oakland wasn't buying multifamily. He wasn't buying residential. He was buying commercial. So he's like, I don't care. So, like I said, it's something you have to look at, though. Yeah.
Are there guidelines for what the improvements have to be?
Nope.
Nothing.
Nope. Nope. So, I mean, what you're seeing is, you know, kind of a typical deal is, again, the client will buy, almost ideally is a parking lot, but something that's got some improvements, but not many, that I can tear down and meet the substantial improvement test, and I can do that in 30 months on that parcel, and I can figure out what I want to do with the rest of them. And I can really enhance, my real value add is on everything else. But I'll buy the parcel, I'll allocate to the improvements, I'll spend to whatever that number is within 30 months, but my real value add is on the rest of it. And I've got basically part of my 10 years to figure out what I'm going to do with that. So like I said, you'll see clients that are really moving towards those kinds of properties, that I can do something to get to substantial improvement, but my real end game is something completely different than that. Yeah. Mm-hmm.
Phil, this isn't so much a question, but just a comment for everybody in the room. Banks have a quota for how many deals
Right.
they need to do.
Yeah, community lending.
And as you get towards the end of the year, banks haven't hit their quota, and they get super aggressive on the terms on these deals. So if you're investing in these spaces, you might find that you're getting different answers from the bank because of where the asset is than what you're used to on normal properties. So
Yeah.
you should know that for your clients. And
Yeah, no, thank you, Sean. I mean, that's a great point. Most of these banks have community lending requirements, and they have an allocation or quota to lend into these low-income communities. And you find, as you get towards the end of the year where they're trying to meet that quota or meet that requirement, they all of a sudden get very aggressive about their willingness to lend into these properties and lend into these communities. And, unfortunately, I was talking to Rami earlier tonight. I mean, unfortunately, there's no exchange that finds the community lending source, the developer that has the property and the ability to improve it, and the investors with the deferred gain that they need to put into the property. There's no exchange that finds those three sources and says, okay, here's the wedding chapel, everybody comes in a different entrance, and you get married here, and you go out with an opportunity zone deal. And that's part of the problem. It's a very disorganized marketplace. And so you've got investors looking for deals, you've got developers looking for investors, you've got banks looking for deals to loan against, and there's just no organization to it. It is truly, the law of the Wild West. You come in guns a-blazing and you hope you shoot somebody, and you hope you don't get shot, in the gunfire. So it's a very, very dynamic marketplace right now, and ultimately that'll get organized, but it's not organized now. Other questions? Okay. Yeah, go ahead.
How closely is the IRS watching what you're allocating to land improvement?
Well, the simple answer is we don't know, because I do this certification on my first tax return. Well, the first tax returns realistically aren't really going to be filed probably until April 15th of 2020. And then I self-certify that I meet these requirements. And the penalty actually isn't horrific if you don't. But we really don't know. So really what we're suggesting to clients is, get an appraisal. Don't just rely on your opinion that here's the value. Now some clients are saying, well, I'll just take, I'll take whatever the assessor does and I'll rely on that because the assessor allocates between land and improvements. And my experience dealing with the IRS is they generally seem to accept that. My experience has been if you show them an allocation that's based on somebody other than just my opinion, they'll accept it, like the assessor. So some clients are doing it that way. But I just think, in many respects, you're getting an appraisal anyway, typically for the loan. Have the appraiser drill down and say, okay, land improvements, and then that way you have it, you throw it in the file, and really what's my benchmark, what's my threshold, and so I just think that's kind of an easy way of solving the problem. Off-market deals where you don't have a traditional lender, those get to be more difficult. But I do think it's worth spending a little bit of money to get an appraisal on it, getting a third-party appraisal. But like I said, clients do different things. Sometimes they listen, sometimes they don't. Okay? Any more questions about opportunity zones? Other than that, I'll spend, 5 minutes talking about kind of what else was in the 2017 Tax Act. If you haven't heard, it brought back bonus depreciation, which from a real estate perspective means if you have either personal property or what we refer to as land improvements, things like landscaping, lighting, curbing, striping, often paving for parking lots. If it has a recovery period, which means it has a depreciable life of 20 years, bonus depreciation means if it's newer used, if you bought it, you get to expense it in the year you purchased it. So basically it applies to purchases after September 27, 2017. And really where this comes in is on exchanges. So Congress changed the rules under 1031 where you only get deferral of gain if you're selling real estate and buying real estate. It doesn't apply to personal property. So if I sold personal property and I bought personal property, whatever it was, fixtures, furniture, whatever, that part of the exchange is taxable. So many taxpayers say, well, wait a minute. Either now I'm partially taxable on the exchange, or I didn't spend all the money. So I had boot at the end. I had cash that I got from the qualified intermediary. Kind of your choice is, well, you can either pay tax on it, or you can go out and spend the money either on personal property, or you can spend the money on land improvements, again, as long as the class life's under 20 years, and you get to expense it. So we've used it as a way of burning off gain from 1031 exchanges. That is, well, we know something needs to be done. The building needs to be fixed. It needs some improvements. And what we're looking at is, okay, well, let's find things that have class lives under 20 years, and let's spend the money on that. Because then we can take the boot, spend it on that, and expense it. So we basically zero out the boot. Capital gains taxes, those didn't really change. 199A, I want to spend a minute talking about that. So Congress, in order to basically, if you're familiar, they cut the corporate tax rate from 35% to 21% on C corporations. Well, pass-through entities like partnerships and S corporations say, hey, what about us? So Congress said, okay, we'll give you a 20% deduction. So your income, instead of being taxed at a full 35% rate, will be taxed at a 29% rate. So we'll give you a tax cut as well. Well, for real estate, rental income meets the definition, provided that the rental income isn't from triple net lease property. So that's one requirement. And the other requirement is you spend at least 250 hours a year in the real estate trader business. And that 250 hours needs to be spent in maintenance, repairs, tenant services, collecting rents, paying expenses, and leasing the premises. So those hours all count. So if you spend 250 hours in your real estate business, then your rental income, assuming it's not coming off a triple net lease, really ground lease payments, can get this 20% deduction. So you earned instead of earning $100 from my rents, I'm paying tax on 80. I got a deduction of $20. So that recently came out in December. The IRS basically said for rental real estate, if you put in 250 hours a year dealing with basically the tenants or maintenance, then it becomes a trader business. It's not triple net lease property, which they could view as not a trader business, and you can get this 20% deduction. So if you have rental real estate, 10 units, 15 units, 20 units, you're probably going to be over this 250 hours, which means you got to keep track of them. And my clients say, well, gee, that sounds awful. Who in their right mind would keep track of their time? Me. I have to do it. I got to do a timesheet every day. So, this terrible situation that you're in is no different than what I do every day. I keep track of my time. I bill in, 6-minute increments. You do that now. And, it's funny. All of a sudden the clients find that that's a problem for them. But, yeah.
How's that work if you're getting rental income from a REIT investment?
Yeah, it doesn't, well, there are some special rules for REITs. So bottom line is you can get the 20% deduction on your share of REIT income, but you don't have, you're not under this rule, you're under a different rule. But generally speaking, yes, the income flowing out of the REIT is entitled to the 20% deduction. Is kind of the way it works.
So when you said December, are you talking about December 2017 or?
No, these rules came out in December of 2018. They're basically proposed regs under the 199A deduction.
Does it apply to other passive investments or just REITs?
Generally just REITs. So, you know, you can get this, basically you can get this deduction for partnerships or LLCs. And then it kind of becomes a question of what's the business of the partnership or the LLC. So if the partnership or LLC is in a real estate trader business, then I can get the 20% deduction on my share. If it's not, then I need to be in the real estate trader business. So it kind of depends on what the source of the income is. Let's see, what else can we say? C Corps versus S Corps, this will be kind of my last point. You know, the C Corp tax rates got reduced to 21%. I'll be honest with you, I don't have people running towards C corporations. Most deals are still partnerships, they're still LLCs, and they're still S corporations. And that's because if I can access this 20% deduction and I can knock off 20% of the taxable income flowing through a partnership or through an LLC, I'm kind of equivalent to where I would have been with a C corporation, because with a C corporation, I still have a two-level tax. C corporation collects $100, it pays $21 of federal income tax, pays a dividend to me, I still pay tax on the dividend. Now that may be at 15 or 20%, but there's still a two-level tax. So because of that, most clients are still using partnerships, LLCs, still using pass-through entities. C corporations are not the panacea that somehow I think people thought they were. For foreign operations, yeah, I'm using C corporations. They make some sense. But for most real estate deals, pass-through entities are still the ones of choice. You know, and just a simple example, you know, if I'm buying a property, let's say for $2 million, you know, I want to seriously look at, should I get a cost segregation study? Because if I get a cost seg study, and that tells me that as I look at this, you know, beautiful, you know, rec center, you know, I buy this. Well, you know, I have paneling, and I have lighting, and I have a PowerPoint projector, and I have electrical cabling, and I have roof tiles, and I have all these other things, which are really personal property and can be removed without damaging the building shell. That personal property is all entitled to bonus depreciation. So I can expense it in the year of purchase, whether it's new or used. And so in many respects, you know, many of the clients that weren't interested in cost seg studies, we're really telling them, you know, look at it. Not that you have to get them, but you ought to be looking at them and deciding whether or not that's something that's a good investment for you. Because if the cost seg study will show you bought it for $2 million, but there's $1 million worth of personal property or depreciable property in the building that you can expense in the year of purchase, the cost seg study paid for itself. So like I said, that's something that, you know, if you bought something after December 27, 2017, it's worth thinking about. It's up to you if you want to do it or not. Okay? All right. Questions? Otherwise, you know, thank you for hanging in there.